The ICT Power of Three is a very strong trading strategy centered on three key phases: accumulation, manipulation, and distribution. Right? And I'll show you exactly how to execute high risk to reward setups based on this trading strategy. But first of all, I need to explain exactly what these three phases are. We have the accumulation phase, that is the first phase right here. We have the manipulation phase above here. And then the final phase is the distribution phase. As you can see, it is illustrated here. Alright? I need for you to understand exactly what these phases are. So the first phase that we have is the accumulation phase. Accumulation is a consolidation period that is usually near the opening price. And as you know, the trading session right before the opening price at midnight is the Asian session. The second stage, manipulation. This is the ICT Judas swing, which is the fake move, right? So this is the move which is described here, which is illustrated right here. This is the move that is used to mislead retail traders into thinking the market is breaking out on one side when it is actually just accumulating or triggering stop losses and triggering sell orders. Let's say in a bullish order flow. Manipulation in a bullish order flow would be used to trigger sell orders. So people who have orders below the accumulation right here, below the Asian session, below this level that is referred to as support level, the people who have their sell orders below here are going to be triggered by this manipulation. The price moves into a higher time frame PDRA at this model stage, breaking out of the consolidation. So once price breaks out right here, we look for it to tap into a higher time frame PDRA, and this higher time frame PDRA could be in the form of an order block, a fair value gap, a breaker block, mitigation block, or an inverse fair value gap. Or it could be a sell side liquidity resting below somewhere before the accumulation phase, right? So that is the manipulation. That is why we call this move the manipulation, because it is triggering sell stops that are lying below here, and people who are going long and have their stop losses below this level are also going to be triggered out. Those people are going to be left out of the main move. That is the purpose of this stage, the manipulation. This move most times occurs during the London session. That is what we refer to as the Judas swing, because price is betraying traders, the reasoning of the traders that are going short. That is why it is referred to as the Judas swing or the manipulation, because Judas, as you know, Judas in the Bible, if you know the Bible, then you know. If you know, you know. I won't go much deep into that topic, but the distribution is the expansion period, which is the real move. This is the move that you want to be trading. This move right here. As you can see, it is large. It has a lot of momentum. It has a lot of volume, right? So price opens at the daily open. That is the accumulation. That is the end of the accumulation. We have the Judas swing, manipulation. Then price moves higher, creating the main body of the candlestick, creating the high, eventually closing below, right? So that is the distribution move. Very easy to understand. So just look at the daily candlestick and look at the daily open, the lower wick, the higher wick, the daily close, and think about the three phases ICT's power of three: accumulation, manipulation, distribution. Very easy to understand. If you are bullish, you should keep an eye out for manipulation to occur below the opening price. Conversely, if you are bearish, you should look for manipulation to occur above the opening price. PDC, which stands for previous day close, meaning the close of the previous day, which can be referred to as the opening price of today's day. Does that make sense? The previous day's close is today's candlesticks open. So if you are bearish as illustrated in these diagrams, in these two diagrams, if you are bearish, you should look for manipulation to occur above the opening price. So let's look at the anatomy of a candlestick, right? This is a bearish candlestick. We have the open right here, we have the high right there, the low, and then finally the candle closes right here. Look for manipulation to occur above the opening price. Look for manipulation to occur above the opening price. Price opens here, meaning the manipulation is this higher wick in a bearish market. The manipulation is the higher wick, and the higher wick is this manipulation right here, demonstrated on this diagram. Price opened at this level. At this level, that is where price opened at. It created the high, which is what we refer to as the manipulation. All right. Smart money uses these manipulation moves to accumulate short or long positions. When people are buying, smart money is accumulating the long positions that are in here. And once we arrive at a higher time frame PD array as described before, a higher time frame PD array in the form of an order block or an FVG or an inverse fair value gap, all those other PD arrays, the smart money reverses. Smart money reverses, right? And what happens to the traders that went long here? Everyone is obliterated. Everyone is obliterated because they have their stop losses down here. Unless you are a seasoned trader and unless you know exactly what the fuck you're doing, only then can you be able to trade the manipulation, because it is very, very tricky. Trust me. You need to focus on the distribution. To confirm the manipulation, you need to see the price manipulated into a higher time frame PD array. And in this case, we have sell side liquidity in the form of these equal lows right here, and then we have a mean threshold of this order block. So we have price reaching down into these relative equal lows and eventually into this mean threshold. So you'd look to enter on the lower time frame other than this main time frame right here. So this could be the 15-minute time frame, and then you would look to catch your entry on the 1-minute time frame or the 5-minute time frame, right? You could enter right when price manipulates right here, when price is triggering these relative equal lows right there. You could enter right there, or you could wait for price to break out of this Asian consolidation and then come back down to mitigate a PD array in here before distributing. So in this case, we broke market structure right here, and then we have this breaker block, which is where price mitigated before buying. So you need to see the price manipulated into a high time frame PD array, a market structure shift, and the price should stay above or below the opening price, depending on whether it's bullish or bearish. So in a bearish setting, you would look to buy while price is within the higher wick, which is the manipulation. In a bullish setting, you would look to buy while price is in the lower wick, below the opening price, right? Distribution must be in line with the daily order flow. So if your analysis tells you that the day is going to be bullish, then you should look for the distribution to be bullish. Don't forget to hit that like button, subscribe, and turn on post notifications so you are notified each time I drop a new video. It's your boy OMG Pips, signing out.
And remember, in forex we're talking about money. We came in this game for money. We came in this game to earn a living. So we are not here to play games.